Our guest today is Dr. Laura Snyder, an international attorney and one of the leading voices fighting for tax fairness for U.S. citizens living abroad. He's the president of Stop Extraterritorial American Taxation, a former international member of the Taxpayer Advocacy Panel and Advisory Committee to the IRS, and a published author on the impacts of the U.S. tax code. Laura, welcome to the show.
Thank you. Looking forward to our discussion.
So, Laura, you moved to France in 1995. What originally brought you there, and what's kept you living abroad ever since?
I originally moved because my fiance, now my husband, is French, and this was his home. So, that's kind of the typical story that I think large majority of people living overseas long term have, which is basically, their spouse or partner is not American, lived somewhere else, and you moved to be with them. And what's kept me here? Well, at a certain point, this became my home. This is my home. The United States is not my home anymore.
Understandable. When did you first realize that Americans abroad face a very different tax situation from citizens of most other countries?
I think that I had, from one moment to the next, I had this aha moment. I think it was a matter of progressively learning things. And also, given that I've been here for so long, the situation when I moved here, it wasn't nearly as dire as it is now. We didn't have FATCA. FBAR wasn't really being enforced. A lot of people weren't aware of the tax obligations. They weren't necessarily taken very seriously. I knew from the beginning only because as a lawyer, I was working in a law firm. I was working in the Paris office of a U.S.-based law firm. And so the other American attorneys were very aware and made me, conscious of it very, very quickly. But I think that was an atypical situation. I think that most people, if they don't have somebody telling them, they would actually have no idea because it's so counterintuitive that, and certainly no one in the country where you live is going to tell you that because other countries don't do this. So it would never occur to them that maybe that's something you need to be aware of. So yeah, I think I learned about it progressively over a period of, many years. And also, again, as it developed. But I would stress that's an atypical situation. That's not how most people learn about it.
So many Americans talk about moving abroad, think about moving abroad. But if they do actually move abroad, what happens from a tax perspective? What do they need to do that citizens of other countries don't have to do?
Well, when someone first moves overseas, they probably won't notice much because the issues kind of build up and accumulate over time. The first issue someone might encounter when they first move overseas is maybe have trouble getting a bank account. Some countries are better and worse than others. But the real issue is the issues come when your financial life is moved from the United States. The center of your financial life is moved from the United States to another country. And the more your financial interests are outside the United States, the more problems you're going to have. So if you just have a salary, you're working outside the United States and you're just earning a salary, you're again probably not going to, you're going to have to file a tax return that's pretty annoying, but that might be the only, and that in the bank account might be the only problems you experience. But once you start trying to invest outside the United States, save for retirement outside the United States, buy a house outside the United States, have joint bank accounts with your spouse, start a business, each one of those things you're going to encounter real problems. And I answered, yeah, basically, so the longer you're outside the United States, the more you're going to experience these problems. And it will not happen instantly. It's not because you just got off the plane that suddenly you have all these problems. It will happen over a period of years. And that's why you'll see that most of the people who renounce are people who are long-term people who live outside the United States. People you can't renounce before you've left. That's not possible. You can only renounce in a consulate outside the United States. And you're not going to renounce if you don't have another citizenship. There's maybe a handful of people who have made themselves stateless, but that's, a very, very small number of people. And generally speaking, you need to have another citizenship in order to renounce. And that takes time. And not everybody's in a position to have another citizenship.
What are the biggest misconceptions Americans have about the tax implications of living overseas?
So I think I would say there's Americans who live in the U.S. that have misconceptions, and there are Americans who live outside the U.S. who continue to have misconceptions. So Americans who live in the U.S. probably don't even think about it at all. And to the extent that they do, they're probably, it would depend, but you'll probably see them either have the intuitive thought that, why would you be taxed by the United States if you don't live in the United States? I mean, Americans who live in the United States aren't taxed by other countries on their worldwide income. So why would you think that it's happening in the reverse? You also might find people, particularly if you start talking to them about it, they might say, well, you're a citizen, you should pay taxes. If you leave the country, it must be in order to avoid taxation, and you should not be, allowed to leave the country and not continue to pay taxes. You really see both of those attitudes. It depends on who you're talking to. I also see that there are Americans who live overseas, maybe in particular the ones that either haven't lived overseas very long yet or who's don't have a lot of financial interests outside the United States. They haven't yet fully understood what is going on because they haven't yet experienced the full brunt of it. And you might find them even defending these policies. You might find them thinking it's perfectly natural. Yeah, I'm a citizen. I should continue to pay taxes. There's still a lot of that, unfortunately. In terms of FATCA, well, FATCA was adopted for reasons that have nothing to do with Americans who live outside the country. In the late aughts, I guess, mid-late aughts, 2007, 8, 9, there was basically a scandal with some Swiss banks encouraging people who live in the United States, I'd like to stress, some citizens, some not, but U.S. residents. There were some Swiss banks that were encouraging them basically to hide their money in Swiss bank accounts, and so that they weren't declaring, their assets and their income from that. And there was a congressional investigation, and it was it was under Carl Levin from Michigan, and it became really quite a big scandal all over the news. And there was, members of Congress thought, okay, we have to do something about this. We need to crack down on these Swiss bank secrecy, etc. And so what should we do? What should we do? And the initial proposal, even Carl Levin's initial proposal, was that we should require banks in tax haven countries to report to U.S. authorities the accounts that they hold for U.S. citizens. But there was another group of Congress people who said that's not enough. We want all banks everywhere in the world, we don't care if it's a tax haven country or not, to identify their U.S. citizen clients and report to us all the accounts that they hold, detailed information about their accounts and about the amounts in those accounts. Any financial account. So, retirement accounts, bank accounts, etc., investment accounts. And that's what was ultimately adopted. And other countries, particularly European countries, there was an initial resistance to it because of the privacy issues. So the United States had to so that was 2010 when FATCA was adopted. So over the next, 3, 4, 5 years, the United States negotiated these intergovernmental agreements, IGAs, with each country that enabled the country to basically override their privacy laws and agree to provide this information. And FATCA actually requires the information about the accounts to be reported twice, because not only does the bank have to report it, but the individual also has to report it as part of their tax return. There's some thresholds in terms of bank accounts that don't have much money don't need to be, it's basically, I think it's $250,000 for an individual who lives outside the United States. If your assets are above that, then you're required to file this form as part of your tax return, which is a separate form from the FBAR, which we can talk about, but I'll focus on FATCA right now. So you have the individual reporting and you also have the banks reporting. The biggest problem that FATCA has posed has been by forcing the banks basically to become the compliance officers for this and forcing them to identify their U.S. citizen clients and report the information, subject to really draconian penalties if they don't do it. A lot of banks have said, we just don't want American citizens as clients and we're not going to take them. Or they'll take them only if they have a lot of assets with that bank. But if it's not a lot, they're not going to bother with that person. And so what you initially saw when the intergovernmental agreements first went into effect, you saw a lot of banks lot of people in the banks being really afraid to deal with Americans on any level. And you saw people's accounts being closed. You saw people trying to open new accounts and being refused. It was really systemic. A lot of people were having problems. Eventually, some banks have kind of figured out how to deal with Americans, some of the bigger banks. But today, still, there are many banks that will not take U.S. citizens as clients, particularly online banks. If you go online and you start to fill in their forms, one of the very first questions they'll ask you is whether you're a citizen or a U.S. tax person. And if you answer yes, in the message will be, thanks, but no thanks, we can't help you. And it'll kick you out. That happens still a lot to people. I think I answered your
And for
question.
someone who's never heard of FBAR, what's FBAR?
So FBAR is also a reporting of your financial accounts, exactly the same reporting, more or less the same information, but it's reported to a different part of Treasury. FATCA is part of your tax return that's reported to the IRS. FBAR is now administered by the IRS, but it's a reporting to the Financial Crimes FinCEN, Financial Crimes Network, or whatever that part of the Treasury is called. The FBAR dates back to 1970, and it was adopted as part of the Bank Secrecy Act as an attempt to combat money laundering. And the rule is if you have $10,000 of assets outside the United States based on the highest balance of all your accounts. So if you have $5,000 in one account and you move that $5,000 in the same year to a different account, you just hit the threshold because your highest balance in account 1 was 5 and your highest balance in account 2 was 5. If you hit that $10,000 threshold, you need to report these accounts, again, separate filing. The penalties for the FBAR are absolutely draconian, very, very high. And what you have to keep in mind is that threshold of $10,000 was set in 1970 when $10,000 was quite a bit of money. That has never been changed, never been adjusted for inflation. The penalties are adjusted for inflation every year.
Laura, thank you so much for joining us. The three of us are long-term U.S. expats. I know Marco's technically an ex-American, but we're three U.S.-born people who live abroad long-term, and I think this was very enlightening. Even though I lived abroad for 20 years, I learned many new things from this conversation. So thank you for joining us.